thank you from all of us. We're going to start today's program in conjunction with the CPE Day with the Tax Reform Act of 2017. The presenters are going to be myself. What's your name? And the guy on my left, my tax partner, Don Johnston. So he and I have done this multiple times. So the biggest problem I have in giving this presentation is keeping him under control. He printed out a schedule of time for me when really he's the culprit. So we're constantly bickering. So if that happens, just someone yell out to keep moving so we don't get into this situation. What we're going to talk about is the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act was enacted last December, December 22nd. And it's an interesting piece of legislation because it marks the most important piece of tax legislation that we've seen come out of Congress since the 1986 Tax Reform Act. Now, there were a lot of politics in conjunction with this that went through. It looks like a bill that was kind of ramrodded through between August and September of 2017 and December when the president signed it. And it worked mechanically through that process in that limited time frame because we had a very odd circumstance, right? We had a Republican-controlled House, a Republican-controlled Congress, as well as a Republican president. Otherwise, it could have never been done that quickly. The 1986 Tax Reform Act, which was a very major piece of legislation, didn't get through for 26 months. It took for Mr. Reagan to build up a group of people that could be put together and vote on both sides of the aisle. It was much more of a politically grouped tax bill that was important in getting that passed. This was a lot different from that perspective. But you shouldn't be misled to think that it was rammed down the Democrats' throat or it was new legislation. In fact, since Mr. Clinton signed the 1993 Tax Reform Act, there's been a great deal of focus on these guiding principles that the Republican Party put forth in conjunction with their position and the way they see things. And it's not meant to convey to you a political position that Don and I have on any aspect of this, but more give you some historical perspective on how these tax bills get passed, because that does have a play. There's just no question. So it's difficult to talk about it without incorporating a little bit of the political background that went there. So there was a bill that was introduced in 2014 when Dave Camp, who was a Republican from Michigan, headed up the House Ways and Means Committee under Mr. Obama's administration. And this bill was called the Tax Reform Act of 2014. They knew, of course, in the House when that was introduced, it was never going to pass because they knew they had a Democratic president and his views on taxation were different from those of the Republican Party. But they set forth in there a framework and a codification, if you will, of what they had basically looked at over the 20 years leading up to that 2014 date, since the passage of the 1993 Tax Reform Act. So in that perspective, they started to build their case, their ball, if they ever had the chance to bring it forward. Move forward now into the election of the president in November 16, which was a surprise to most of the people in the nation. And we had a fully loaded Republican machine, if you will, in Washington. So it looked like there was going to be tax legislation very quickly into his administration. And in fact, if you go back as far as Mr. Eisenhower's administration, but Mr. Kennedy in particular, Mr. Reagan, Mr. Clinton, the first President Bush, and the second President Bush, all of their major tax bills happened very early in their administration. In the first 6 months, their first initial tax bill. What Mr. Trump focused on was getting rid of Obamacare and the Affordable Care Act. Obviously, they weren't successful in doing that, but he spent a lot of his political collateral, if you will, or political assets on trying to do that. It didn't happen. So in the summer, once a vote was over, they had a big push by the conservatives that had elected him to focus on tax reform and to get it done quickly. So on September 27th of last year, they released a document which was called a Unified Framework for Fixing Our Broken Tax Code. At the end of the 86 Tax Act, the tax code was about 3,500 pages. By the time we get to last year when it was reformed again, it was about 12,000 pages. So it had grown exponentially over a long period of time, not just because of a Democratic president, but through all the presidencies, because certainly the first President Bush raised taxes, Mr. Bush, the second president, had 9/11 to deal with. They had a lot of initiatives and incentives. But all those provisions over time continue to build and add complexity to its tax code. So this framework was intended at the forefront to put together some guiding principles that the public could see were coming in the forthcoming Tax Cuts and Jobs Act, which was later enacted. And those goals and motivations were what you see on the screen, and the types of things that you would think would be in any tax bill that had to be used to get passed. Certainly tax relief for middle-class families. That was a big push on the Republican side of the aisle here. It's always been a focus point of the Democratic positions as well, of course. So I think if you have a mixed Congress like we are going to have going forward in January, once the people were sworn in from the election the other day, you're going to have to work a little more bipartisan to get something accomplished. You're not going to get anything accomplished in tax law in the United States without helping middle-class taxpayers. That's just a central theme of everybody. They also wanted to simplify the tax filing for the vast majority of Americans that are out there. You'll see as we go through here, they accomplished that to a degree, and Don will talk about that in a few minutes, about how fundamentally we're moving towards a lower amount of itemizers, people that take itemized deductions in their 1040 filings. And those of you that prepare your own tax returns or prepare returns, you know what that process is like. Don will elaborate. They want to provide some relief, tax relief for businesses, especially small businesses, but they went through all businesses. And there was the issue, of course, with the federal tax rate of regular corporations, which was the highest in the industrialized world. We'll speak to that this morning as well. They wanted to end the incentives for shipping jobs, capital, and tax revenue across the ocean. And that's been accomplished. They were really using kind of an antiquated international tax code inside the regular Internal Revenue Code, Title 26. And ultimately, what they've done is they've simplified that and changed that so it's more beneficial and more attractive to companies to keep the jobs in the U.S., continental U.S., and pay the tax at the U.S. tax rates. And then finally, they were looking to broaden the tax base and provide, fairness, which none of these goals anybody would look at, no matter what your political persuasion, and say there's anything difficult or wrong with these goals. The question is, how do you get there, and at what expense, and how does it work with the deficit and everything else? Those are all the mechanical gyrations, if you will, that are built into the tax bill as it moves along. So how does it accomplish those goals? Well, on the individual side, it reduced the individual marginal tax rate somewhat, and Don will speak to all of these. It expands the standard deduction and the child tax credit. Keep in mind, it eliminates the personal exemptions in 2018 and going forward that we've all known through our entire professional lives. It adds some greater simplicity because it is going to minimize the number of people that file itemized deductions. And so a lot of the record keeping that you have to keep, charitable contributions, tax records, mortgage interest statements, fewer people are going to be in need of those documents in preparing their filings as well. And then finally, it does provide some aid to middle-class families, and we'll talk about some of the new credits and some of the credits the way they work. For businesses, the big change is the one that received all the press, because I think the media likes to glorify that the big corporations aren't paying any tax, but they moved the 35% tax rate down to 21. And we'll talk about what we think that means in the world of restructuring companies, because that's a big change. Expanded a lot of the capital acquisition benefits. That was a policy that was basically started by President Reagan in 1981 in the Economic Recovery Tax Act, because at the end of the 70s in Mr. Carter's administration, there was a real problem with the economy. The inflation rates were very high. Those of you that were around then will remember that you could get interest rates on CDs at 20%. Totally safe investments paying 18, 20% interest rates, so forth. So there's a lot of calamity in the economy when Mr. Reagan took office. In his first tax bill, that ERTA, that Economic Recovery Tax Act, he made sure that there were provisions there for very fast write-offs of assets. What does that do? Well, of course, that's obvious. It reduces taxable income by the quicker write-offs, saves the taxes, increases operating cash flow for those entities. This is the most significant expansion, though, in this bill, the Tax Cuts and Jobs Act, that I've ever seen in our career. We've never had an opportunity to expense 100% of the assets as we buy them. So that's something that we're thinking about as well. An individual provision, though it kind of drives off of business income, is a new deduction called a Section 199A Qualified Business Activity Deduction. And really what that does is it takes pass-through enterprises and crops 20% right off the top. We're going to talk about that a little bit more later. That's a big deal, because what it effectively does is there's a top tax rate that's out there for individuals. It's reduced significantly because only 80% of the income is going to be taxed at the shareholder level or the partner level. And we'll go through how that works as well. And then it eliminates the corporate alternative minimum tax, which is a hated parallel tax system. You'll note when Don talks about the AMT for individuals, it didn't go away, but a lot of the attributes of the mechanical calculation have been revised such that there's going to be fewer and fewer, far fewer people that get affected by AMT going forward. There's also some simplified cash basis accounting rules, some basic fundamental mechanical rules for calculating taxes for small businesses that have been simplified, and then it changed the international tax regime as we talked about earlier. Unfortunately, today is not really going to give us time to go into the international provisions in depth, but we'll talk about it briefly this afternoon. Mike Weber will comment on this a little bit. Will this tax bill work? You know, lowering the federal corporate tax rate, is that going to give us a better economy going forward? I really don't know. What I would tell you, and what we've observed, there's the Tax Institute in Washington that monitors how these tax bills affect the overall economy. I really don't know what that means. I mean, all I can tell you is that they use consistent procedures looking at one bill to the next bill to the next bill. Well, when Mr. Kennedy took office, the top individual tax rate was 75%. So they dropped those rates fairly substantially in the Kennedy administration, and it worked to boost the GDP by 5 to 6% over a longer period of time. The same thing happened when Mr. Reagan had that 1981 Economic Recovery Tax Act. It worked as well to help the economy grow by 3 or 4 or 5%. So it boosted the growth in the economy by getting people to hire employees and buy equipment. It increased manufacturing and got us out of the funk that the economy was in at the end of the 70s. On the other hand, the 86 Tax Act, which was a major piece of legislation, which lowered rates significantly, measured the same way, didn't produce that significant an effect. And in 1993, when Mr. Clinton took the rates all the way back up to 39.6%, where they were prior to this law, that didn't really have a negative effect. So, you know, you would always hear the Republican side of the aisle argue that if you take more money out for federal taxes, that's going to have a detrimental effect on the economy. Not always. It didn't happen in Mr. Clinton's administration. So it's hard to tell. The problem is, the issue is that Don and I always talk about is they need to leave the laws in place a little bit longer so you know what's happening. 40 years, I've been practicing, almost 40 years. And in that 40 years, I think there's been 34 major tax bills. So, you know, the law changes every single year. It's almost impossible to plan long term for the way it's going to push out. So I'm not really, you know, I got to be honest, I haven't really dug in to do the scientific analysis of how those studies work, but I think that general setup should give you some thinking or some assessment of what might happen out of this tax bill. We won't know for considerable time. I will say in the short term, it got a lot of hot press last December and January, you'll remember, and people were giving bigger bonuses. The bigger companies like Apple and Time Magazine, some of the other ones, were giving big raises and bonuses to their hourly employees. There was also increases in pension contributions. There's definitely, without question, a very substantial economic effect of additional capital expenditures being made by companies because they get the write-offs. So all of that kind of leads to the thought that at least in the short term, it's had a boost, and the economy is really going like gangbusters, right? And I don't know how you measure how much of that has to do with the tax law itself, but it does have some impact. The other thing I would mention is, and Don will speak to this at length, but all of the provisions that are effective for individuals are temporary in nature, and they have an expiration date, which is a new trick by Congress, and in this case the Republicans used to get the thing through the votes necessary to get the law enacted. But it has a lapsing feature, which is going to cause a need for some kind of additional action by Congress before it lapses, or there's going to be a discontinuance of a lot of what we talk about today on the individual side. There's a new set of packages that have been introduced into legislation called Tax Reform 2.0. That's really not the name of the bill itself. There's actually 3 tax bills. One of those tax bills are to make the individual changes permanent. The second one is to help savings programs and retirement plan programs going forward as well. And then the third one is to enhance the tax incentives for investing in research and development or research and experimentation. So those provisions all work towards business, and probably, you know, what limited insight I have to the inside Washington, you know, beltway, the Democrats could probably get into and work with the Republicans in conjunction with the retirement plan incentives and the R&D incentives. I'm not sure that there's going to be enough horsepower to get the permanency of these individual provisions through a vote, and that remains to be seen. The House passed it and approved it prior to the election because I think they had the fear of what's happening at that time, but it was never had the power to get through the Senate anyway. So even if that Republicans had held on to the House, that bill probably wouldn't have gotten through the Senate. So it's there as well. I think the big thing is that you have to focus from your own perspectives, and if you're doing individual returns, focus on seeing where people are positioned now. And we spent a lot of time on this. The tax books and the first seminars that Don and I put on were before the end of January, and the law was passed on December 22nd, was enacted. We put a lot of effort into getting up to speed as quickly as we could with the groups, and we presented many, many times since then on this fact sheet, both together and separately. So we know it's going to have a profound effect on the way people are doing their taxes. It clearly changes the overall structure of the tax code for individuals, more so, again, than any piece of legislation I've seen over my entire career. So a lot of people are going to be ill-prepared, and the people that we're most concerned about are not our clients per se, but more so their employees who maybe aren't as prepared. So if you have a blue-collar guy, someone in the shop or plant making 70 grand, he has 2 kids, and all of a sudden he does his tax returns and finds out he owes $1,000. That's going to be a difficult circumstance for him. And even the W-4 filings where they tell you how much withholdings that you're supposed to withhold has changed significantly. And so those rules, you know, in conjunction with all this other information is overwhelming. I would also tell you that we had the tax law in December. We've had 7 major sets of regulations proposed since then, and we've probably had another 100 pieces of guidance that have come out of the IRS. So it's a very fast turnaround to put us from where we were then to where we're going now. So with that little bit of background on there, I'm going to turn it over to Don. He's going to talk about the family and individual tax changes, which are going to affect almost every one of us. There you go.
Thank you, sir. Great introduction, great history. I could sit and listen to him for hours. And by the looks of everybody, I think everybody's in the same. But so here's a question for you, Bob. With the Democrats taking over the House effective January 1st with the midterm elections, should we expect any type of tax bills? Well, I think we're going to expect some Democratic tax bills coming out of the House, which we know will not be passed, right? They won't make it through the Senate and won't make it past the president. So should we expect the Democrats to throw tax packages out within the next 2 years in anticipation of the 2020 presidential run? Because that's what happened back in 2014, right? The House, the Republican-controlled House, threw out a bill for no other reason than say, hey, this is what we're going to run on in the next presidential election.
Yeah, and then that 2014 Tax Reform Act did, of course, serve as the basis for the campaigns, but not only by Mr. Trump, but by all that big, you'll remember that big Republican candidate field, 8 or 10 people. They're all running principally on the same tax program, which was built on that 2014 tax reform bill. If there's anything that I think would change, would be introduced, it would be tax hikes for higher income individuals. But you'll see that the rates themselves didn't really change. And you know, the way these things get spun is the problem in the politics. And I think all of us are exhausted from looking at the partisan fighting and backbiting that goes on in Washington. But the reality is this is not really that beneficial to wealthier taxpayers because they lose a lot of advantages and the rates are nearly the same. So it's not as the windfall that they thought it was. Where it may be beneficial, of course, is where the pass-through companies get a little bit of a tax break, and I'll talk about that later. I don't see legislation being promoted by the House with Democratic control and the House Ways and Means Committee being chaired by Democrats because it's not going to go through the Senate. You can't make it. So even if they approve it in the House, every time out, they're going to fail, and then they're going to look like they're not necessarily incompetent, but that they're unable to make anything happen. So I don't expect that we'll see a big deal on the taxes on that side. And of course, historically, the Democratic Party is more about, helping people and doing what they can to do that. So their goal, if anything, I think, would be to preserve Obamacare or try to beef that up in the Health Care Act and put that back where it was before the Republicans got a hold of it.
Perfect. So my section, we're going to talk about the impact of the Tax Reform Act on individuals and families. So I know that you guys are paying attention now, and I'm not expecting everybody to be completely focused for the next hour as we go through this. So these are the things that are the important things. So if you're going to crash at the end of this, you're going to tune out. These are the things to remember, okay? As far as the individual changes, the rates have been changed. Itemized deductions have been changed dramatically. This is the most significant change to itemized deductions in my career, and I'm going to dig into that. Exemptions have dramatically changed. The personal exemption, claiming your kids, completely gone. You don't get those exemptions anymore. Child tax credit completely changed. It's doubled, which is going to open it up to a lot more people than were able to take the child tax credit before, and I'll talk a little bit about that. And the standard deduction has nearly doubled. The doubling of the standard deduction is where some of the simplicity comes into play. The simplicity that the Republicans pushed when they were getting this package through the system. Simplicity to make it a little bit easier for everybody to file their tax returns, at least for most Americans to file their tax returns. Like Bob mentioned, the individual changes do sunset. What sunset means is if the law is not extended, then automatically in 2026, we revert back to 2017 tax law. And so we talk about temporary. That's what we mean by temporary. The provisions will sunset at some point. The pass-through deduction that Bob talked about, 20% for pass-through income. And Bob's going to spend about 25, 30 minutes talking about that pass-through deduction, and that's the 20% deduction that Bob mentioned. And then business changes. When I talk business changes, we're talking C corporation changes and to some effect other business changes like depreciation, bonus depreciation, some other things. And that provision is permanent, right? But is it really permanent? There's really nothing that's permanent, because the only thing that permanent means is it takes an act of Congress to change it. So I would call those business changes temporary, because let's think about what possibly could happen in 2020. So right now we have the Democrats controlling the House for the next 2 years. The Republicans currently control the Senate, and obviously we have a Republican president. So what happens in 2020? Let's assume in 2020 the Democrats keep the House, and we have a Democratic president in 2020. So at that point it comes down to who wins the Senate, okay? Every 2 years, there are approximately 30 to 35 senators that are up for re-election. In 2020, of the 34 senators that are up for re-election, 22 of them are Republican. That's a lot of seats up for grabs in 2020. So if the Senate changes and the House remains with the Democrats and there's a Democratic president in 2020, then a lot of these changes that are permanent very likely would be changed. A lot of the individual things that we're going to talk about today may be changed. So we may only have 2 more years of the current tax law before things are changed, depending upon 2020 and the election in 2020. The midterm elections, and for me, it's so painful to go through the election cycle, right? Every 2 years you have this election cycle. It's just painful with the ads and the craziness and the money wasted on everything that we all see. All the signs in everybody's yards, it's just absolutely crazy. I think 2020 is going to be completely chaotic, and it starts today, right? We have 2 years, and already we're going to start hearing both parties talk about moving forward, both parties talking about the 2020 election. It's going to be a big deal. It's going to be very big, and it's going to have a big effect on tax law going forward, depending upon what happens in 2020. So it'll be very interesting. So let's dig into some of the individual provisions. Again, the individual provisions are temporary. At some point, they will expire, starting in 2026. So I'm going to try to break this down to try to make it as easy as possible. And a lot of what I'm going to talk about is fairly basic, but I want to talk about it because I think it's important. So the changes for individual taxpayers, the majority of the changes are not on the income side. So if you had adjusted gross income last year of $100,000 and nothing changes from your earnings, the chances are your adjusted gross income this year is probably going to be right about the same. There's no significant changes to the income side. Most of the changes are after your income on page 2, or your itemized deductions. That's where the changes come into play. Those changes are standard deduction, the exemptions, itemized deductions, and a child tax credit. Okay, so all of those things are not on page 1 of your return. So this is, remember last year when we were talking about the postcard? Remember Paul Ryan about 4 years ago standing talking about the postcard? They kind of did that. You know, for many Americans, probably 75% of Americans are going to be able to file on something that kind of looks like a postcard. This is the first page. This is the first page of the return going forward. This is an actual draft. And I don't expect you to be able to read all the details. I just wanted you to see that it is actually a postcard. It looks like a postcard. I'm not sure if it's going to be that small. But this is the first page of the return. And they kind of just condensed a lot of things. So what they did is, you know, on the first page, just a generic information, your name, you know, Social Security, all that good stuff. That's the first page of the postcard. Now, a lot of times you think of a postcard, right? You know, on the postcard, you have a really cool picture on one side, and on the other side, you have the address and all that stuff. Well, that's not like, the return is not like that. We're not going to see a cow surfing on the other side of our postcard here. So what we have, we get into some of the details of the return. And like I said, probably 70 to 75% of Americans will be able to file. This is the meat of the return. It includes the income. So let me blow through some of the stuff real quick. Line 1, wages. Line 2, taxable interest, qualified dividends, Social Security, IRA, and additional income. Now here's where we're throwing. We have a little bit of a curveball. Line 6 says, see attached Schedule 1. That's where we get into some of the more complex things. But if you don't have other income, if all you have is wages, a little bit of interest, which most Americans are there, right? Most Americans only have W-2 income, maybe a little bit of interest, maybe not. So if you don't have a whole lot going on, the postcard's probably going to work for you. And you can still itemize by using the postcard, or you can take the standard deduction. And like we talked about, most people will be using the standard deduction now as opposed to itemizing. And one of the things here that I'll point out, line 9 is a qualified business income deduction. That's the 20% deduction that Bob's going to talk about later. I just wanted to point it out so you can see where it is on the tax return. So what I have filled in here is just an average U.S. house payer or a taxpayer. The average household income in the U.S. for a family of 4 is about $60,000. $60,000, which is W-2 wages, which we report on line 1. No other income. They don't have any Schedule C income, no interest, no dividends. So that comes down to line 7, your adjusted gross income. Same way it was in prior years, right? Except it's just on a different form. And then line 8. In my example, family of 3, husband, wife, and 1 child. The standard deduction is $24,000. In prior years, that standard deduction was only $12,000. So standard deduction pretty much doubled. Okay, and then taxable income on line 10, $36,000. Under the new tax law, the rates have changed a little bit. They've come down a little bit. Total tax of $3,900, and the child tax credit of $2,000. That's a big number. The child tax credit of $2,000 is pretty good, and that child tax credit is for children age 16 or under. $2,000. So you have your net tax of $1,936. Excuse me. This is about $1,300 or $1,400 less than it would have been under 2017 tax law. So middle class America, generally the savings are projected to be somewhere between $1,300 and $1,600 depending upon your particular situation. Okay, so you can see the tax savings here. That effective tax rate, $1,936, that effective tax rate is only about 3-4%. So it's a very low tax rate for somebody, for the average American. Okay, so let's move to, remember I pointed out that Schedule 1. Schedule 1, I pointed out that Schedule 1. And this is what Schedule 1 looks like. Schedule 1 is breaking out the other things, the things that most Americans don't have, okay? You've got your Schedule C. And interestingly enough, you'll see the numbers. You may not be able to see them from the back of the room, but the line numbers are actually exactly the same line numbers that we had on the prior year return. So lines 1 to 9B, it says reserved. It's reserved because those items are included on page 2 of the return. Then, for example, line 10, taxable refunds, it was also on line 10 last year. So in effect, what they did is they kind of took some of the items from the old return, just put it on a new schedule, thinking that most people won't even be using this schedule. Okay? But if you have Schedule C income, line 12, so you'll still have to complete a Schedule C, and that's where it would go. Capital gain income, Schedule D, also you fill it in here, then you have to attach the Schedule D. Get down, lines 15A, 15B, those are reserved. Why are those reserved? Because those are IRA income, retirement income, Social Security income. It's on page 1, or on page 2 of the return now. So they kind of just took some of the things that most Americans don't have, put it on a separate form, it's called a Schedule 1. Down below, adjustments to income, same way as it looked before. Adjustment to income, some of that would be student loan interest, health insurance for self-employed, and things like that. So this is just blown up. This is the top part of that schedule. And then when you add all these things up, get to the number, then you put it back on the page 2. Not a whole lot of complexity there. They're just changing how the forms look. Not a whole lot of complexity once you look at it and you figure out. And like I said, a lot of the things are on the same line as they were in the prior year. So it'll be easy to compare your last year's return to this year's return. You can do it on a line-by-line basis. You just might have an additional form. So let's talk a little bit about some of the changes for individuals. Okay, like I said, the changes that we're going to see are on the second page of the return, as the way we looked at it last year. So the tax rates have changed. On the screen you can see the old rates and then the new rates. And like Bob said, the changes are not material. There's still 7 tax rates, but every bracket changed except the very lowest bracket. The 10% stayed the same. So now the highest rate is 37% as compared to 39.6%, okay? So if you simply take your income and your taxable income from year to year stays the same as it was last year, this is the type of savings that most people will see. And I have 4 different examples here. The very first one is $75,000 married filing joint. You can see the tax liability between 2017 and 2018 with a $1,700 savings, okay? Which is what the Republicans told us, right? They said most Americans would have somewhere between $1,300 to $1,700 of savings. So you can see that. And then you can go all the way down, married filing joint with $750,000. And again, I'm just showing this so you can see the difference. But what this assumes is your taxable income stays the same year to year. Your income is going to stay the same. Your total income is going to stay the same. But where you're going to see changes is things like itemized deduction and standard deduction. That's where you're going to see changes. For most people, your taxable income actually is going to be higher. All things being equal, your income is the same on page 1. All things being equal, once you get after adjusted gross income, most likely your taxable income is going to go up. But the changes in the rates will reduce some of the tax liability. Okay, first thing, some of the changes. The repeal of personal and dependency exemptions. Okay, in prior years, if you're under the income thresholds, like a $4,000, $4,100, somewhere in that range. So a family of 4, you get about a $16,000 deduction from your adjusted gross income. Those exemptions are completely gone. Whether you have 1 kid or 9 kids, it doesn't matter. Those exemptions are completely gone. And for some people, that's a pretty big difference, right? That's a pretty big adjustment because if you have 4 kids, plus husband and wife, that's 4,000 times 6 people. Those are huge deductions. Those are gone. Those were replaced with the increase in the child tax credit. Child tax credit under old law was $1,000 per qualifying child, and now it's $2,000. And part of this change to the child tax credit is to make up for the fact that you lost the exemptions. You have a comment?
No.
Okay. The other thing that's important here is the thresholds for eliminating these has been increased. Under prior law, once you hit about $110,000 of income, you started to lose that child tax credit. That exemption, that phase out doesn't start now until about $400,000, which is good. A lot more people will qualify for the child tax credit. So the child tax credit going forward, if you're under $400,000, you get the child tax credit, but the child has to be under age 17. So the question, I've had a lot while I'm speaking about this is, well, geez, what about my college-age kids? Can I not claim them anymore? You can still claim them, but you get credit for them is only $500. So in that particular situation, if you were claiming them and get a $4,000 deduction before and only getting a $500 credit now, you're probably going a little bit backwards there as far as the college-age kids are concerned. Changes to the standard deduction. Talk a little bit about this. Standard deduction, for the most part, has close to doubled. And that's what I have on the screen right here. So just married filing joint, the standard deduction under the old law was $13,000. Under new law, it's $24,000. So in reality, what does that mean? So now if the standard deduction for married filing joint is $24,000, a lot more people will be able to use a standard deduction. So it's going to eliminate the number of people who are going to itemize going forward. And the projected numbers are in prior years about 30 to 33% of Americans itemized. And under this new law, they're thinking probably between 8 and 9, maybe 10% of people will itemize. So a lot of people who used to itemize will not be itemizing anymore. So let's think about who itemized. At what point do you start to itemize? Well, for most people, it's when you buy your first house, right? Because when you buy your first house, you now have mortgage interest. So the mortgage interest and the state taxes you paid, and also when you buy that house, you now have property taxes. So under the old law, the mortgage interest, the state taxes, the property taxes, and any income tax from a state point of view, and charitable deductions, those were deductible before, and you would itemize based upon those. And I've got a lot of clients. We probably do 250 individual returns at our firm, and most of our clients are fairly organized, but we have a handful of clients who are still staying stuff in shoeboxes. It'll be nice for us to not have to sort through a lot of that stuff for some of our clients who will not itemize anymore. It's going to make it a lot easier for a lot of people who will not itemize anymore, because you don't have to keep track of that stuff anymore. So there's a little bit of simplicity there, because there'll be less people itemizing. One of the things that is a little bit painful here is what about those business owners that have S-corp income or partnership income, and they have flow-through income? You might have flow-through income of a couple $100,000 coming from that flow-through entity. You have to pay tax on that from a state tax point of view, but now you don't get to deduct it on your itemized deductions, because there are limitations on how much state income tax you can deduct on your Schedule A. So that's been a little bit painful with respect to, it's a little bit, we think it's unfair to the business owners who have those pass-through entities, because if they were a C corporation, they'd get a state tax deduction for their state taxes. But since they're a pass-through, they no longer get a state tax deduction. So it's in our eyes, it's unfair to those business owners to lose that tax deduction.
Yeah, I think if you look at that standard deduction issue and the individual exemption issue, think of the family of married couple with 2 children that are middle school age. So they had 4 exemptions before. At $4,050, that's $16,200. So they lose those deductions. On the flip side, they end up getting a credit for each of their 2 children of $2,000 that they couldn't have gotten before. So if you're in a 25% tax bracket, then of course the tax is $4,050 on those. The tax benefit of those 4 exemptions was $4,050. Your 2 credits add up to $4,000, so that's kind of a wash. The credit reduces the tax dollar for dollar. So when you do that, that leaves the gap then in whatever your total itemized deductions were before and the $24,000 expanded standard deduction. So while most people in higher income ranges are going to see their income go up because they're going to lose certain tax benefits that were allowed before under old provisions, lower income people, middle income people should see a reduction, because they only needed $12,000 before to itemize property taxes, charitable contributions to church, state local income taxes, and mortgage interest. So they only needed 12 to surpass that. But understand, if they had 14 in total, then you itemized. That's how we filed the tax returns in the past. That would have been appropriate. Now they still only have 14, but they're going to get a $24,000 standard deduction instead of itemizing, and so they have a $10,000 windfall or decrease in their income in addition to all the other changes that came through. So middle income taxpayers and lower income taxpayers should see a decrease in taxable income because of that type of a circumstance.
Yeah, and that's exactly right. When we completed our returns for our clients in April of 2018, for our clients, what we're doing, let's look at 2018, see where you're going to be in 2018 with respect to tax reform. And for the majority of our clients, we were seeing that either their tax liability was around the same, but in most cases was slightly lower than it was in 2017. Now, as the income went up, the more income they made, a lot of times we saw bigger reductions or the lower tax liabilities. Where we saw clients that actually had an increase in their tax liability are clients that, in a lot of cases, some of my elderly clients that had a lot of broker fees. They didn't have a whole lot of income, maybe $100,000, $150,000 of total income, but they may have had large broker fees. So they're giving a lot of money to charity, and they had large broker fees, and those broker fees were deductible as an itemized deduction in prior years. Under the new law, those brokerage fees are no longer deductible as a miscellaneous itemized deductions. So I might have had a $20,000 to $30,000 deduction that they lose because they can't deduct it going forward anymore. The other clients that we saw had some difficulties as far as we're foreseeing that they have higher tax liability are folks who have vacation homes, folks who lived in high income tax states like New York, California, you know, the states where they were getting huge state tax deductions because the state tax liabilities are so high, or their property taxes were so high because they have a vacation home. They're losing those tax deductions as an itemized deduction. So those are the type of clients that we saw that we're seeing a higher tax liability in 2018. So just let me summarize the changes to the itemized deductions. I'll go a little bit into detail. Medical expenses, very few of our clients qualify unless they're elderly and they have very high medical expenses. But the medical expenses actually expanded a little bit, so it's a little bit easier, not much, but a little bit easier to claim medical expenses. State and local income taxes limited to $10,000. So it doesn't matter how much state and local income tax you have, you can only deduct $10,000 going forward, which is a big deal, and I'm going to dig into that a little bit. Mortgage and home equity interest, there could be some limitations. If you acquire a home in 2018 or after that, if the home costs more than $750,000, you can't deduct all of the mortgage interest. So in Pennsylvania, not that big of a deal, right? Because there are not that many people living in houses that are $750,000. Most people in Pennsylvania are not living in those type of houses. But what if you go to a place like San Francisco or New York, where every place, an efficiency in San Francisco is $1 million or $1.5 million. So if you live in those states, you've got some serious limitations here because of the $750,000 threshold. The charitable donations has been expanded just a little bit as far as how much can be deducted. And the miscellaneous itemized deductions are now completely gone. And that is a little bit of a big deal for some people. Like I said, some of my elderly clients are deducting those broker fees. But where it's really stinging people are those employees who have a lot of employee-related expenses that can no longer be deducted. So let's assume I'm a traveling salesman. Let's assume I'm a traveling salesman. I have a lot of out-of-pocket expenses. And that's just part of what I have to do. I mean, I'm making a big buck from the company, but they will not pay for my travel costs. They will not pay for my entertainment costs. I used to be able to deduct those as miscellaneous itemized deductions. And we have some clients that spend $30,000, $40,000, $50,000 on those type of expenses. Well, those expenses can no longer be deducted. So those are gigantic expenses and a huge benefit that people were able to get in prior years that they can't get anymore. So let me spend just a little bit of time on the state and local deduction. Like I said, that limitation is now $10,000. So you can't deduct more than $10,000. This really hurts people in high tax states like New York and California because in prior years they could have had significant tax deductions. Because their state taxes are so high, the property taxes are so high, limiting it to $10,000 can be a big hit for a lot of those people. And we've seen a lot in the news, a lot in the press about the politicians in those states pressing really hard to get this overruled. I would expect that if the Democrats take over Congress and the White House in 2020, this is probably one of the first things that will be changed.
Yeah, and I would stand corrected my earlier comment. This is something that the Republican senators can't deal with either, because their high-income constituents who are making the big donations are getting stung here. The Democrats are in a lot of the big urban areas where the costs are just ridiculously high, as Don said. You might see some kind of action in 2019 on the House Ways and Means trying to modify this provision in particular. I don't know where they would fund it from to do that, but I think that's likely to come. And I think you may be able to find some bipartisan support in the Senate to make it happen, just because a lot of the senators have very wealthy, a lot of Republican senators have very wealthy constituents as well.
Yeah, this has been a highly contested issue for since this tax law was passed. And one of the things that people tried to do to avoid this is a lot of people, some of our clients did this. They tried to prepay their taxes in 2017 because they knew they weren't going to get a deduction for them in 2018. So they prepaid their taxes in December. I got a couple of notes from clients that, hey, I just prepaid all of my property taxes for next year. I just wrote a check for $20,000. Well, unfortunately, under the law, you couldn't do that. You weren't allowed to do that because those taxes weren't technically assessed, and you can't take a deduction for something that's prepaid like that. So it was, and also for some of my clients who did that, they were actually an alternative minimum tax, so they didn't get the deduction anyway. But it was very interesting how many people did this. And we saw, one of the very interesting things was City of Allegheny County, they opened up their office at the end of the year, like the 29th, 30th, and 31st. They actually were open, and they were taking payments that people wanted to make. And it was interesting because I knew at that point that wasn't a legitimate tax deduction. So I actually called down to Allegheny County and said, hey, what are you guys doing here? What's the plan? And I didn't tell them I was a CPA. But I said, what's the plan here? Are you giving people receipts for, what are you doing? Are you giving them a tax bill, or are you giving them some type of assessment when they pay this? And they were very smart about it. They actually thought it through. They said, no, we're not giving anybody an assessment. We're giving them a receipt that they paid it. So Allegheny County did the right thing. They took your money without putting themselves in a position by giving you something that was an assessment that would allow that tax deduction. I would have done the same thing if I was the head of Allegheny County. So it's the right thing to do. You're getting money in the door. You let people make their own decision on their tax returns. It'll be interesting to see how the IRS reacts to this, to see if they actually hit people over the head, or if they try to check to see if people were taking tax deductions for those prepaid taxes. A couple other things that have happened here with respect to this is some states have set up some type of programs, a charitable deduction program, where instead of making state tax payments, you make charitable contributions to charities that the states want you to give money to. And you can take a charitable deduction as opposed to taking a deduction for state income tax. One of the things, and interestingly enough, I had several clients that actually did this at the end of 2017. And for some of my clients, it was the perfect situation. We were actually making money, meaning that they can make a $10,000 contribution to an organization and save $12,000 of tax. It's hard, I can show you the numbers, how it works out, but people were actually making money by doing this, and it was completely legitimate. And Pennsylvania has programs that have been around for 25 years that would allow that to happen. The IRS came out with a ruling in the summer, mid-summer 2018, that basically said, no more. We're not allowing this anymore. And they actually made the right decision. And the decision was, you can still save state taxes, but we're not giving you a federal tax deduction for that charitable deduction, because in effect, you're getting something in return. You made a $10,000 contribution. You saved $9,000 in Pennsylvania tax, so you're getting something in return, so we're not giving you a $10,000 federal contribution. So the IRS, they ruled on this, and at the end of the day, in my opinion, they came up with the right answer, that you cannot take that deduction. So it's still a good thing to do if you have, we still have clients making contributions to these charities. It's still the right thing to do if you're already going to give money to those charities. You still get the Pennsylvania credit, so I can make a $10,000 contribution, and it only costs me about $700 out of my pocket because I can have such a big savings in state taxes.
I would just make a comment to you that your time's up, plus a 2-minute cushion for my comment on the schedule that you put together. So please continue.
I make the rules, I don't have to follow them.
I told you, that's what I deal with.
Just a couple of minor comments to finalize my presentation here.
Didn't mean to throw you off there.
No, that's all right. Minor changes to mortgage interest. Like I said, there's a $750,000 threshold now as far as the mortgage. One of the things that changed, it kind of catches some people off guard, is if you have a home equity line of credit, you used to be able to deduct that interest as an itemized deduction. Going forward, you can only deduct that interest if you use it to improve your home. Okay? So if you took out a $100,000 line of credit to help your kid pay for college, you used to be able to deduct that interest. You can no longer deduct that interest. You have to use the money to improve your home. And that kind of was always something that people got caught with if they were in AMT, because that interest was never deductible for AMT purposes. Although I will tell you that any of my clients, I never asked the question because I didn't want to know if they used it to improve their home, because I didn't want to make it an AMT add back. So I never asked that question because I didn't want to know. I talked already about the repeal of miscellaneous itemized deductions. The itemized deduction limitation, we don't have to worry about that anymore because that limitation is gone. Just a couple comments related to changes to itemized deductions. We need to be paying attention to the standard deduction. A lot of us won't be itemizing anymore as we go forward. And that the reduction of the itemized deductions is going to lead to higher taxable income. So we should be paying attention. We need to make sure that we're thinking about 2018 before it's too late, because we're getting close to the end of the year. The new itemized deduction form, I have it here. There's not a whole lot of changes here. This is the top part of the form. One of the changes you'll see on the taxes you paid is there's a line 5E talks about the limitation. It can only be, it's limited to $10,000. The bottom part of the form, not too many changes except for other itemized deductions are gone. Just a couple small things that most people won't qualify for, but that's what the form looks like. Not a whole lot of changes there. Alternative minimum tax has not been repealed for individuals, but AMT is just not going to catch as many individuals as it used to catch. We're thinking that about 90% of people who paid alternative minimum tax in prior years will not be subject to AMT going forward, and for two reasons. The exemptions are gone, which was a big add back for AMT, and state tax limitations. You know, without that big state tax deduction, it's no longer going to be an add back for alternative minimum tax.
Flip back one slide. Yeah. On the estate and gift tax side, there was a very substantial change. Just 15 years ago, after the Tax Act 2001 that Mr. Bush signed, the exemption was only $600,000, and that had been boosted up. Now, it is adjusted by inflation for a 1998 bill that allows that to mechanically move forward. But where we're at now is we're at $11 million with inflation adjustments. They took the exemption from where it was to $5 million to $10 million. So it's $11.2 million right now with inflation. So ultimately, if you look at that for a couple, you've got $22 million of property that could be transferred during your lifetime from senior generation to junior generation without any tax effects. And Don and I are trying to get our hands around what that means. What it means principally, and my partner Melissa Bizak, who helps in the valuation group and works in that group, you know, one of the things we see is a slowdown in the amount of people that are doing estate planning, because the reality is there's no federal death tax for most people on moving assets from senior generation to junior generation now because of these very high thresholds. But I would tell you, you have to keep in mind that this expires in 2025, as Don said, and as permanent as anything could be, we know this in particular is a temporary sunsetting provision where it'll drop back. So something to keep in mind. The other thing we're seeing that we're observing, especially from the big wealth planners like PNC's group and some of the other wealth planning firms, is upstream gifting. And by upstream gifting, I simply mean historically, everybody has taken a standard fundamental strategy of give at least $14,000 away, whatever the annual gift tax exclusion is, move that value out of the parent's estate down. Now, unless you have a really substantial estate, that's not really going to matter anymore, except that you still have Pennsylvania inheritance taxes when you move it from parents to children. But that's an issue. The problem is when you gift during lifetime, you get a carryover tax basis. So if you do have assets of value which were non-liquid stock in a privately held enterprise, we move it down to junior generation. What we're finding is, or what we know, I shouldn't say what we're finding, what we know by statute is that kid gets the giftee, the person receiving the gift, has the same tax basis as the dad did or the mother did on the transfer. So make the simple example that you're gifting shares that have a value of $100,000. Dad started the business with $1,000. That's his tax basis in that asset. You give it to the kid, $100,000 gets considered in the use of the exclusion, but the actual basis that the kid has in the stock, the person receiving the gift, is only $1,000. So when they sell that share, they have a $99,000 capital gain if it's capital stock. Now, if you hold on to it alternatively, and this is a simple concept that most people understand, there's a code section 1014 that allows a step up for basis for property received by inheritance and death. So if you held on to the same $100,000 asset until they died and they distribute it to the children as a result of the father passing, of course they get $100,000 of value, but they get $100,000 of tax basis. So it can then be liquidated with zero taxable gain or capital gain at that point. The question now, with the exemption being so high, where did you want the value always? You want it to be in younger family members because those people, not always, but aren't likely to die before the senior generation members. Now we see an opportunity to do upstream gifting, meaning Don and I start a business, it's very successful. My dad is 97 years old. We give him the gift, okay? Got to have a good relationship so he doesn't give it to your sister when you die or when he dies. But you give it to your dad, you get it back through the inheritance. He still doesn't have an inheritance tax problem, or not a inheritance tax, but he doesn't have a federal estate tax problem because the company's only worth $8 million. But your basis jumped by doing that transaction from the $100,000 that we used to start the business to the $8 million that's worth the date of death. So it's just going up to him, coming back down when he dies in 3 years. And a lot of people are getting involved in those kind of sophisticated transactions, which I won't say they're not, without pause, and they certainly should be undertaken with a great amount of care, but it's a way to get that step up and get it back to the senior generation now. And then if he gifts that shares later to his son or his daughter, he's going to get an opportunity to move down that higher basis to them at that point, because they'll get the carryover basis that he received from the dad with giving it back to him. So those are the kind of little things that we're seeing in there. We're seeing some penalty issues. 2 single taxpayers, two people live together, but they're not married. In those situations, they each get a $10,000 state and local tax deduction. If you're married, you only get $10,000. So there's a marriage penalty in there. And there's a lot of these little nuances that I would even stand here and advocate the position that Don and I have a grip on every single thing. We know going forward, it's going to be a tough busy season with the integration of a lot of new changes. So we need to take the time to make sure, and you need to take time to make sure that you fully understand this before you get in there, especially once you get past the January 15th point, which is the last date to be making payments of tax without getting the incurrence of penalties. So you need to make sure you understand what your tax position is for this year.
And last comment I have on this is, I actually have a client in this situation. He has about a $20 million estate. He's single. Good tax planning there might be to get married, right? And if anybody's looking, by the way, because what happens there, he's 65 years old. He gets married. He passes $11 million to his spouse tax-free without having to pay estate tax on that.
Yeah,
Again, better have a good relationship there.
Yeah, that's right. Did you talk about the alimony at all?
And I didn't address
Yeah, the other thing I would just mention before we jump off the individual changes, obviously there's a lot more to all of this than we can cover in such a short time, but the alimony provisions have changed too. Thank you, Cody. The alimony situation is that after 2019 and forward, alimony structures will not be deductible anymore. And historically, that has been a long time allowance under the Internal Revenue Code, where I'm getting divorced, I'm in a 40% tax bracket, my wife is a homemaker, so she's not going to be able to be employed, at a gainful employment that I can, because I've had a whole career and she's been home for 25 years, 30 years. So what the play is on that, and what helps family law attorneys resolve these issues, is that they structure some of the support that's going over to the spouse as alimony. She pays tax at 15 or 20%. The payor spouse, the property spouse, he or she ends up with a 40% deduction, and you have that arbitrage. And what that arbitrage does is it allows for a bigger marital estate, more money in the pot to be able to fund the ongoing households of 2 people. But now that's going to be gone. It's being phased in. So if you have a 2018 agreement or back, you're going to be okay. But post 2018, December 31st, alimony will no longer be deductible. And that's a big change, biggest change in family law I've heard from many family law attorneys over their whole careers. We're going to talk for a few minutes about this pass-through entity deduction. This is called Code Section 199A. Everything you read, they keep referring to the code section. So Don and I don't like to give these presentations getting too much into the technical statutory numbers, but it's a 199A deduction. It's essentially a qualified business deduction or business activity deduction. So just by the name, what you should first sense is that you have to understand what kind of business is qualified. And we're going to get into that in a little bit of depth, not the degree of depth that we need to. We've had managers in our group teaching hours and hours on this for 3 months, so it's a rather complex issue. Before we start, you have to have an appreciation of how we got here. And we got here because of the 1986 Tax Reform Act. In that act, The highest individual tax rate was 28%. There were only two brackets, 15 and 28, when that law was passed. And there was a corporate tax rate of 35%. Prior to the 86 Tax Reform Act, the rates were 50% for corporation, or excuse me, 50% for individuals and 46% for corporation. What did I say? 50% for individuals and 46% for corporations. I apologize. So what people did is they accumulated earnings in corporations because the tax rate was lower. And if you didn't distribute it out as a dividend, which is a non-deductible event for a corporation, you could just pile up money in there with some consideration of the accumulated earnings tax rules, but you would pile the money up there. When they passed the 86 Tax Act, that was the first time since pre-World War II that the individual rates were lower than the corporate rates. So there was a rush to reorganize and restructure all of these business entities. Most of them were being operated in consolidated groups of companies, even smaller companies, because they would be able to utilize losses from one activity against another, and they had the liability separation by having multiple entities in their structure. After the 86 Tax Act, all that went away. We rolled up all those companies into the parent, so you had a single standalone company, and then we elected S status so that we could get the lower tax rates, the 28% rate, on the pass-through income. Well, you know, it only took till 93, 7 years later, until the individual tax rate was 39.6 and the corporate rate was 35. So it didn't take long to swing it and move it back around to where it had been in the past. But that was the initial game, and that's why so many companies were formed that way back in the late 80s and early 90s to get to this end of reaching that rate arbitrage of paying individual tax rates on corporate income. Now today, obviously, S corporations continue to be the preeminent corporate structure for privately held enterprises, but we also see a significant proliferation of limited liability companies that are taxed under Subchapter K as partnerships, but for the same reason. The issues are different. There's still value to being a pass-through entity, and we'll talk about those, Don and I, as we go through this, but understand that the rate arbitrage element, which was the big motivator at the beginning to get everybody into this pass-through mode, is no longer a relevant process as well. Okay? So what we're going to talk about is this 199A deduction. You have to understand how these pass-through entities work, first of all, and I'm sure most of you do. Obviously, the income is generated at a corporate level. There's a mechanism, a vehicle called a Schedule K1, which breaks out the corporate entity income and all of their attributes among multiple K1s for all of the ownership group. K1s are distributed out to the ownership group. Ownership group reports that income on their 1040s as pass-through taxable income. So that's basically the enterprise. So now what's happening is I'm getting an allocation of $500,000 of income. Don's getting an allocation of $500,000 of income. Our tax rate goes up, and now we owe another $200,000 of taxes. Where does that money come from? Well, historically, most of the partnership agreements, operating agreements we see provide for a mandatory distribution from the enterprise, because it is the enterprise's income, to the ownership group so that they can use those funds to pay the taxes. That doesn't necessarily mean that they have to push out more money than what's necessary to pay the taxes, but in the realm of fairness and reasonableness and economic returns, it's required that they distribute enough money to pay the income taxes. So that's where we're at, and we're bringing these big tax liabilities out to the individuals. The problem is now you see this big tax rate change at the C corporation level from this Tax Cuts and Jobs Act. And in that, they moved the tax rate from 35% to 21%. Don will hit that a little bit as we move forward. That didn't change the tax rate, though, on these S corporations. So if you think about pre-Tax Cuts and Jobs Act income, you had a 39.6% federal rate and a 3.07% Pennsylvania rate that was deductible, so maybe 2 points. So now you're at like 41%. If you had the C corporation rates, you had a 35% corporation rate, generally 34, because that's companies with less than 10 million of taxable income. And then you had a 9.99% Pennsylvania rate on those corporations, tax affected to about 7.5. So the sum of those, they were very close to two rate arbitrages. The corporate scenario and the other on year-to-year tax needs, cash flow needs to fund tax liabilities was very similar. Now it's changed significantly, and that's because the corporate rate itself at the federal level has dropped to 21, while the pass-through income, the guy that's running the Ford dealership structured as a S-corp, or the guy running an LLC that's a small manufacturing company, he's being taxed at 37% on the pass-through income. And so the need to do something to separate the two companies, the two types of forms of structures, but at the same time yield some kind of significant benefit to them. And that's what's happened here. So for tax years beginning after 17 and before 2026, this is an expiring sunsetting provision as well. And the reason for that is because it's applicable to individual shareholders, partners, members of LLCs, or sole proprietors. So it comes down onto the 1040s is where this benefit is, not at the corporate level. And so these individuals are the people, or these groups of owners are the people that qualify for that ownership break. That's important to know. So because it is this group, then it gets lumped under the individual provisions and it gets part of the sunsetting temporary nature of the rules. Okay, so the qualified business income, subject to multiple thresholds. There's a fundamental income threshold thing that we'll talk about in a minute. If you're under the bottom side of that phase-out range, no limitations whatsoever. As long as you're a qualifying business activity, you'll get 20% off the top. Okay. It's not allowed in determining your adjusted gross income. As Don showed you in that draft, that initial release of the 1040 for this year, there's a line on the back of the 1040 after your standard deduction that allows you to do the QBI deduction. And you're going to have to do the QBI deduction on other forms which are going to flow into that 1040. Okay? It's not an itemized deduction, of course. And then states and trusts can qualify for this deduction as well. So exactly how are the mechanics of this? We're not going to spend a great deal of time breaking into the details. I just want to give enough to whet your appetite and let you understand a little bit. This is the way tax legislation is written for those of you that don't read it regularly. And God forbid, we read it a lot more than we wish we had to. So the deduction itself is the lesser of the combined qualified business income amount, okay, or 20% of the excess of the taxpayer's taxable income over the taxpayer's net capital gain and the taxpayer's aggregate qualified cooperative dividends. And this is great language, plus the lesser of this 20% of the aggregate qualified cooperative dividends or the taxable income minus the taxpayer's net capital gain. Really all they're getting at there's a whole lot of mumbo jumbo. They don't want capital gains coming through and taking benefit of this. They're trying to look at operating companies and take operating income. So if you have a company that's structured as a C corporation or as an S corporation or partnership for federal tax purposes, that income's passing through to those individual owners. Ultimately, it's an issue of basically looking at the operating element of that income. Now, how's that going to be determined? That's going to have to be determined by the people preparing the 1065, the partnership return, or the S corporation return, the 1120S, so that they provide the information on the K1s, so when the shareholders, the owner group, gets their K1s, they can take it to their accountants or they can use it to prepare their tax return. Those decisions on qualification and so forth will be done at that level up above. But it will be reflected on the returns, and the economic anomalies associated with the benefits are going to show up at the individual's returns.
And it'll be very important for those of us who do tax returns, or those of you who are CFOs, running different companies, and they're getting, the individual owners are getting these K1s. It's going to be important for us to review those K1s to make sure that they make sense, to make sure that the information that's provided to do this calculation makes sense. For example, if I have a client who has an investment in a manufacturing company, and it's a large manufacturing company that employs a lot of people, the disclosure on the K1 should get me to the point that allows me to take a tax deduction of 20% on all of that income. I should be able to think my way through to see if that disclosure makes sense, and it's very important. Similar to the DPAD deduction, the domestic production activity deduction before, generally I could look at a K1 and say, okay, this makes sense. This deduction they're allowing here makes sense based upon the disclosure. But as preparers and as tax professionals and as people who have control over some of the owners' information, we want to make sure that somebody reviews K1s prepared by perhaps smaller firms, less sophisticated and not sophisticated enough to really understand the details here, to make sure that the deductions that we are getting here make sense.
Yeah, we can't stress that enough. It's an important point that Don makes. So there are limitations. So if you think about the deduction in its rawest form, a single owner S corporation with $1 million of pass-through income, a qualified taxpayer, and we'll talk about taxpayers that aren't qualified. But the Roth deduction initially is 20% of the million. So he gets $1 million on his K1. That's going to show up on his total income pass-through. But then he's going to get a deduction down below his standard deduction based on that draft form of $200,000. So he does have $1 million of income that belongs to him as an owner of that S corp, but he only pays tax on $800,000. So what does that do? What that does mechanically to the rates and bringing some relief to these privately held business owners is it reduces the tax rate on the true operating income from the 37% top marginal rate to 29.6%. So it's a big deduction, a big reduction in tax cost. And I think it's a fair reduction because it makes sense that just because the company's formed in one way in the Internal Revenue Code, it shouldn't be so penalized as to not to enjoy some of the benefit that's given to the regular corporations with that reduction to 21%. So it makes logical sense that you would have that kind of a setup. Now the $200,000 deduction that I just mentioned can be subject to certain limitations depending on where your income is. And there are two sets of dollar limitations, which are taxable income limitations at the owner level. Now, that's an interesting thing because Don and I are going to be calculating these returns and putting this information out so people can calculate it, but we won't know the final outcome of the deduction availability. That'll be on whoever does the tax returns or whoever does their own tax returns that are the owners of the companies. A lot of them we do, but some of them we won't. So the idea is, if you think about married filing joint, first of all, there's a range of income, $315,000 to $415,000. It's cut in black and white. That's as clear as can be. No issue there. On singles, on everybody else that's non-joint filers, the state gifts everybody else, that range goes from $157,500, half of the joint filing threshold, to $207,500. So there's a $50,000 change, but it's 50% of where that range is before. And you'll see how that range works. But if you exceed those thresholds, if you're a non-joint filer, if you're above $207,500, or you're a joint filer and you're above $415,000, then you have full impact of these deductions or these limitations. And the first is that $200,000 deduction that you get, 20% off the million on the pass-through, it can't exceed 50% of the W-2 wages. That's one alternative test. There's a second alternative test, which is the sum of 25% of the W-2 wages plus 2.5% of the unadjusted basis of certain property the business uses to produce qualified income. I mean, what does that mean? It's operating assets. So what are they trying to do here? They're trying to give this opportunity, this tax benefit opportunity, to companies that have real employees that are out there creating jobs and buying capital expenditure equipment, which is basically boosting the economy. They don't want it to go to lawyers. They don't want it to go to accounting firms, although I would argue that we've created a few jobs. But it's really for operating companies, and that's why these kind of thresholds are in here. So when Don talks about the manufacturing company, probably not going to be a problem for that guy because he has $1 million of taxable income. He gets a $200,000 deduction. Odds are he has $400,000 of W-2 wages or greater, and then ultimately he's not going to be limited by this. So you have that capability, but you need to take a look at that. Now, between the 315 and the 415 for joints, between 157.5 and 2075 for non-joint filers, there's a phase-in of those limitations. And that's where it's going to be a little hairy and a little tricky in the mechanics if you fall into that range in doing your tax return or looking at this issue on behalf of clients. And we'll get into an example, but just very quickly, because again, we can't spend the time to get through it in a big way.
And just to clarify, these figures that Bob talks about, the 315 and 415, that's taxable income. That doesn't have anything to do with the flow-through income. The flow-through income obviously is included in taxable income, but these limits are based upon taxable income.
Without consideration of the 199A deduction.
That's right.
Without consideration of the deduction. So it's basically your personal tax return income as an owner. And remember as well, you remember the definition was the combined qualified business income So it's basically calculated on all the K1s, all the pass-through income that you're getting. So we would have a taxpayer that might be a partner in one enterprise, a S corporation shareholder in another enterprise, and possibly a sole proprietor for a third activity. All of those are going to be combined to calculate this deduction. So you have these three impact areas. So if you're under these thresholds for non-joints and joints, then it's just 20% off the top. That's not going to happen with somebody with $1 million of pass-through income because they're already over the top. If you're in between these ranges, then you have a phase-in of the limitations, and if you're above the 415 and the 2075, then you have the full impact, as I just said. Okay, so if you look at this example just real quickly, we have qualified business income in this particular example of $250,000. So 20% will give this person a $50,000 tax deduction. So the wages on his return are 100, the ordinary income from qualified business is 250, and then the capital gain is 15. So he has $365,000 of taxable income. His deductions are $50,000, so his taxable income is $315. That's right at the bottom of the threshold, the bottom part of the threshold for joint filers. So obviously done purposely for illustration purposes. The taxable income in excess of the 315 floor, there is none. The limitation phase-in range is not applicable since we're under 315, so the limitation in the phase-in range is 0. So we determine the taxable income before the QBI, that's 315. He gets $50,000 right off the top and pays tax on $265,000. This is going to be an important issue. And where we see things that really seem to break out as interesting is people restructuring how they're paying payments, especially in lieu of wages in an S Corp, and also in lieu of how they're paying guaranteed payments in a partnership. In an S corporation, obviously, if you pay W-2 wages to the owner, that's going to count in the W-2 limitation if you need it, in calculating that 50% of W-2 wages or 25% for the alternative. But if you lower the wages, then you're going to boost up the pass-through income. It may be more beneficial to do that, take advantage of a higher pass-through income at lower wages, and you'll get 20% of the higher number. Now, you have to be careful in an S corporation scenario because there are certain reasonable compensation rules. You have Bob, the wallboard contractor, and it's only me, and I make $250,000 on my solely owned S corporation, and I take no wages, so that I get that $50,000 deduction we just saw in this example. Well, the service isn't going to like that because who's providing personal services? I am, and you have to basically take some reasonable compensation out for your personal services, which would then not qualify. It would reduce the income if you took out $50,000 of salary and reduce your QBI benefit accordingly. Now, on the partnership side, it's even a little more interesting. Do you want to touch on
yeah, on the partnership side, it comes down to guaranteed payments. And the question comes up, are you actually required to take guaranteed payments? If you're a partner, let's assume Bob and I, obviously we're partners in a partnership. Do we have to take guaranteed payments, or can we just have everything flow through on line one? Well, let's assume that we qualify for this deduction. We're better off having 0 guaranteed payments, and all of the income flows through, and we just increase the amount of the Section 199A deduction. So you can have a partnership where all of the income comes out as guaranteed payments. Maybe that's what you've done for the last 25 years. All the income comes out as guaranteed payments based upon how much of the income I've made, how much Bob has made if we're 50-50 partners. But under this new law, perhaps the right answer is we don't take guaranteed payments anymore. We take distributions out of the company. So what happens is our guaranteed payments goes to 0. On line 1 of the return, our income is exactly the same as it has been in prior years, and it would have been if we were taking guaranteed payments. We still paid the same amount of self-employment tax, but we've just created a huge tax deduction under 199A that we would not have been able to get if we had had guaranteed payment income.
Yeah. So there's going to be a lot of planning around this, I think, as we go forward for those people that qualify. Then the question becomes, well, do I qualify? And that's an issue. And it's pretty straightforward. If you're a healthcare provider, if you're an accountant, if you're a lawyer, it doesn't apply, period. So you're a specified service, trade, or business if you're listed as one of those. And the descriptions that came out in the Treasury regulations in August basically parallel the personal service corporation regulations that have been part of the law for many, many years. So that's what they're looking at, kind of personal service providers. Now, a really tough one is this idea of consulting, because they basically exclude consultants by saying that consulting is defined as anybody who provides any kind of information that helps the person being provided the information attain their overall goals. Well, I think that can apply to almost everything on Earth. I mean, even a guy manufacturing a sheet metal box for IBM to wrap around their computer, that's meant to advance their goals, but it's not in the consulting realm as we would define it. So keep in mind that specified service businesses, they kind of get screwed out of this. They don't get the benefit, except if they're under this lower level of the threshold. So if you're a smaller practitioner or a smaller partner in a big firm, and you're under these taxable income thresholds, if you're under 315 and you're joint filer with your spouse and you're a lawyer, you get to take the 20% right off of that income, even if you're a lawyer, even if you're an accountant or a consultant. So that's an important attribute. If you're between 315 and 415 for joints, and 157.5 and 207.5, then you have a phase out. You'll get some benefit, but not nearly as much as you would have if you were under the 315 threshold. Then finally, when you get on top of the 415 threshold, the top of the thresholds, nothing. So if you're a law firm and you have pass-through income from the law firm that pushes your taxable income up over 415, then you don't get to take any tax advantage being a specified service, trade, or business. So again, I don't know if I totally agree with that, but I think it reinforces the conceptual emphasis behind the provision to basically help real operating companies who are creating jobs for manufacturing type jobs, distribution type jobs, and also investing in capital equipment as well.
And the main thing to take away from that, in my opinion, go back to that one if you don't mind. The main thing to take away from that is if you're marriage filing joint and your taxable income is under 315, you qualify. You don't have to worry about all these other goofy tests. You don't have to worry about anything else. But you're only going to qualify if that income is flow-through income and not guaranteed payment income. So we've heard and talked to several law firms where they've changed how they compensate people. You might have a law firm with 50 people in it, and perhaps, let's assume there's a law firm with 50 partners. Okay, so they're getting flow-through income, and most of those partners, maybe 2/3 of those partners, are under that 315 threshold. So if they change how they're compensating people, 2/3 of their people are going to qualify and be able to take a 20% deduction on that taxable income that flows through from the partnership return.
Yeah, I just want to wrap up this part of the discussion with this idea of trying to reconcile the tax break that they've provided here for the qualified companies, the companies to which this benefit applies, to the corporate tax rate of 21%. And we get asked regularly, hey, the tax rate that I'm paying is 37%, 29.6 for federal tax purposes if this applies, but my buddy's paying 21% in a C corporation. So why shouldn't I restructure and reorganize as a C corporation? And I can't tell you how many hours Don and I have spent noodling this, running scenarios. We've had our managers helping us run calculations 1,000 different ways. We don't really think that's necessarily a good idea. And what we would say is clearly, anytime you reorganize a corporate or operating entity structure, there's a lot more things to think about than just tax. But on the tax scenario itself, we don't think that's appropriate. And the reason is this reconciliation process. Again, the federal rate on the corporation is going to be 21. The state effective tax rate is going to be about 7.9, because now you're only going to save 21% on the 9.99, the 10% of Pennsylvania tax. So now you're at 28.9 for U.S. tax purposes, federal and state, on a C corporation or a regular corporation. On the individual side, you're going to be 29.6% on the operating income element, and then you're going to have Pennsylvania taxes, which are not going to be deductible any longer, because those pass-through taxes, as Don noted, are no longer going to be deductible. So you have to add the whole 3.06, so that takes you up from 29.6 to about 34%. So there's a spread there. And obviously, it's not immaterial when you start talking about 4 points on your taxable income every year. The problem is in the liquidation or exit of the company at the other end. Because to get the money out of the C corporation, you have to distribute it as a dividend, now subject to a 20% tax rate. plus a 3% Pennsylvania state tax rate. So you're essentially adding 23 percentage points more onto that scenario where it's liquidated at the other end, where there is no such similar taxation of the pass, whether it's an S corp or a partnership. So the idea of this second layer of tax that's required on a potential sell of the asset at the end makes it very disconcerting to think that this 4% per year is going to help you. The issue is if you're only getting 3 or 4% spread year to year on these structures going forward, and then you have a whopping additional tax on the exit of the company at the other end, then it's going to more than offset in present value dollars the benefit of the year to year spread. So I'm not saying that there isn't some initial benefit year to year on being a C corporation versus a regular, but we think in the overall life of a business from creation to exit is going to put you in a position to ultimately be able to take that deduction. You're going to want to stay a pass-through business enterprise.
Yeah, one final thing to add on this topic is comes down to tax distributions. So if you're a controller, CFO, or CEO of the company, the owner is always looking for tax distributions, right? If there's flow-through income that ends up on their tax return, they want 35 to 40% of that so they can pay their own taxes. With this tax deduction here, you should be able to reduce the amount of the distribution because there should be, in many cases, should be a 20% deduction. But you may have a situation where 3 of your 4 shareholders qualify for the deduction, but the other shareholder doesn't qualify for the deduction. Well, what are some of the reasons why that other shareholder may not qualify? Well, it might be because their spouse makes $1 million a year. Because their spouse makes $1 million a year, they're over the threshold, so they don't get that 20% deduction. But the other shareholders get that 20% deduction. So as the controller, when they come to you and say, hey, I'm not getting this deduction, you owe me a higher tax distribution. You got to make sure you understand, one, what the operating agreement says or what the shareholder agreement says with respect to tax distributions, because you have a situation where you want to follow the agreement, but we all know who's writing the checks, right? The bosses are writing the check, the shareholders are writing the checks, paying your salary. So you need to be paying attention to things like that because you have very different tax consequences depending upon how what the income is at the top level.
Okay. We're gonna just spend a few minutes we have left on some of the business changes, and Don will start that off, and we'll go through it together. But we'll at least touch base on where they're at. Go ahead, Don.
So from a business point of view, we're talking at the C corporation level. C corporations pay their own tax, and Bob has already mentioned this. The top tax rate under the old law was 35%. That's been reduced to 21%. Again, primarily because we wanted to make U.S. corporations more competitive worldwide. The worldwide rate, the average worldwide rate, was somewhere in the neighborhood of 20 to 22%. So being at 35% in the U.S. didn't make sense. It made us less competitive, which is one of the main reasons that this rate has been changed to 21%. This is permanent, contingent upon what we talked about earlier, down to 21%, and effective for tax years after 2017. So it's effective in tax year 2018. So we're already seeing the benefit of that in our C corporation clients. Alternative minimum tax has been completely eliminated for corporate purposes, which is fantastic. We don't have to worry about taking that into account anymore. No more depreciation schedules, no more ACE depreciation schedules. So that falls off the face of the earth, which is very good for us as preparers and tax professionals. If there are any AMT credits, those carry forward indefinitely. You will be able to eventually get those. And you should, and the way the process is you should get that entire credit back before the end of 2021. Another limitation, which this is both on C corporations and pass-through entities, is a limitation on how much business interest you can deduct. We've run a lot of calculations for our clients. We have a handful of clients in this situation where if your business interest expense is too high, you can't deduct all of it in a given year. And there's a limitation based upon what they call adjusted taxable income. So to get to your adjusted taxable income, you take your taxable income, add back the interest expense, add back the depreciation, take that number and take 30% of that number, and you can't deduct more interest expense than that 30%, whatever that comes up to be. I know we have one client in particular where this is a pretty big deal because they have a significant amount of debt. It's a very big company. They have a significant amount of debt. So we've got to plan around this business interest limitation. Now, if it's limited, it's a temporary difference. You will be able to deduct it at some point in the future. It's carried forward forever. You will eventually be able to deduct it, but it could cause some short-term pains if you're not expecting it. Like I said, companies with a lot of debt have to be thinking about this. This is both for C corporations and pass-throughs.
Yeah, and Melissa and Brad are going to spend a little time from our valuation group this afternoon talking about some of the impact of these items. This interest in particular is going to change cost of capital calculations, and it makes borrowing more expensive than it was before if you're subject to this. So it's something to think about operationally, you know, in your roles as CFOs and so forth, that you may not have an ability to deduct this interest fully, especially in conjunction with companies that are having that are above the threshold for exclusion, 25 million, but at the same time are having operational issues and difficulties in generating operational income.
Yeah, and Bob, what he just said in the 25 million, these rules don't apply for businesses that have gross revenues of $25 million or less, which is a good thing. So if you're under that threshold, and you have to throw all the companies together, the affiliation rules come into play. But if you're a standalone company with only one company and no other affiliated companies, as long as you're under $25 million, a lot of things have been changed for those types of companies. For example, the interest rules, the special interest rules don't come into play, and you're allowed to change the method of accounting to cash basis, which you couldn't do before. That's been made a little bit easier. And for Section 263A purposes, if you're a small business under 25 million, you don't have to calculate Section 263A inventory limitations anymore, which is a very good thing. And again, effective for tax years beginning in 2018. All right, one of the biggest changes to businesses for our clients has been the change in the bonus depreciation rules. Effective in 2008, actually effective in September, for acquisition September 27th, 2017, and before 2023, bonus depreciation now is 100%. You can elect out of it if you want, but if you don't elect out of it, bonus depreciation is 100%. So anything you're buying out there, whether it's a $100,000 piece of equipment or a $4 million piece of equipment, if it's machinery and equipment, something used in the production activity, manufacturing activity, if you choose, you can deduct all of it in the year of acquisition. And the thing that's very important here is the bonus depreciation rules now apply to both new and used property. Under the old rules, it had to be new property. Under these revised rules, you can buy used equipment and take bonus depreciation. That's a very big deal when it comes to business acquisitions. And we do a lot of M&A work, a lot of business acquisition work, or selling some of our clients. And this is a very big deal when you're acquiring a company. Excuse me. So let's assume we're going on, we want to buy the assets of a business. We're going to buy the LLC, all the units of an LLC, which gets taxed as an acquisition of the assets. The acquisition price is $20 million. Let's assume the assets that we acquire, we have accounts receivable, inventory, fixed assets, and goodwill. So we're paying $20 million for these assets, and this is the allocation based upon our balance sheet. So if we have GAAP, here's our GAAP income. We have $4 million of pre-depreciation book income, $4 million. We have GAAP depreciation of $2 million. So our net income for GAAP purposes is $2 million. Under the new bonus depreciation rules, we'd be able to deduct the entire $10 million of those fixed assets in year one. So we have pre-depreciation book income of $4 million and tax depreciation of $10 million. So we have a tax loss of $6 million. This is a big deal for large acquisitions because we're talking about acquiring a company, going out and buying a company, and being in a situation where we're likely not going to have to pay tax for several years because that NOL or that tax loss, we either get the benefit for it this year or we get to carry it forward and offset taxable income in future years. So we just bought a company for $20 million, and we can be profitable in many cases for 3, 4, 5 years without having to pay any income tax on the federal side. That's a big deal because that completely changes your short-term ROI, right? And think about not having to pay tax for 3 or 4 years at the business level. That's a very big deal. You want to comment on that?
Yeah, the only issue I would say, and I agree with him completely, we've talked about this ad nauseum, but the other thing you have to factor in there is once you eliminate drive that $6 million loss, then you've lost the $199, the QBI deduction forever. So there's planning that goes into integrating these aspects of the code that we're not even totally up on yet until we get in and look at it and study particular circumstances. But facts and circumstances certainly can dictate, some of your decisions on these kind of opportunities. It would be a rare opportunity where you wouldn't just expense the assets and forget the 199 deduction, but it could occur.
Right, and there are a lot of other things that come into play also. The interest limitation.
Yeah.
You know, we've got clients who've had interest limitations, bonus depreciation limitations, and net operating losses limitations, all because of tax reform. Section 179 has been expanded. I won't talk about that because I want to jump on to the NOLs because we only have a couple minutes left. So the net operating losses. As a C corporation in prior years, if you had a net operating loss, you could carry it back 2 years, offset taxable income the last 2 years, and carry anything forward. It's always nice to know that, you know, if you had a bad year, you had a couple good years, then you had a bad year, that bad year you can take that NOL, carry it back. Can't carry that loss back anymore. For tax years beginning in 2018, for losses generated in 2018 or forward, those losses can only be carried forward, okay? Anything that was sitting there in 2017 can still be carried forward, or it can still be carried back, but anything generated in 2018 or forward can only be carried forward. And any losses generated in 2018 and forward can only be used to the extent of 80% of your taxable income in future years. So let's assume we have a $10 million loss in 2018. We can carry that forward to 2019. 2019, we have $10 million of taxable income. Well, we can only use 80% of our loss. So we're kind of stung there because of that new 80% limitation. And a limitation like this used to be in the law for AMT purposes, which occasionally would come and bite us in the backside. But now we're going to see it in certain situations going forward, assuming it does. The law and tax law doesn't change. We're going to see this going forward. It's a big deal, you know, when you're planning around all those things I was talking about, right? You've got interest limitations, AMT, interest limitations, NOL issues, and also depreciation issues. You have to think about all those things when you're doing planning for businesses. Last couple of points on the business changes. The DPAD deduction is gone. With the change in the tax rates, reduction from 35 down to 21, we no longer need that DPAD calculation because that calculation was trying to get us to the point where we're more competitive worldwide. With the rates changed down to 21%, doesn't matter anymore. Business entertainment expenses, no entertainment expenses are deductible going forward. Okay, if you have Penguin tickets, can't deduct the cost of those Penguin tickets. You go out to a Steeler game, can't deduct those entertainment costs anymore. You can still deduct the meals related to that to the extent of 50%, but any entertainment costs are completely non-deductible going forward. So obviously our Penguin tickets just got a lot more expensive, right, because we can't deduct them anymore.
Yeah, the other thing I would tell you that's important is I know some of you are just like dozing off saying, well, I work for an exempt organization, so I don't care. But really, your unrelated business income under 511 and the calculation of that tax, the UBI tax in 511 and 512 and 13, all of these rules apply expressly to those as well. So you're going to find even in the exempt organization community that where you have unrelated business income tax, you're going to have some impact from this that you're going to have to consider in these rules, especially as it gets into depreciation and so forth. We do a lot of 990 type work and tax exempt organization work where they do have unrelated business income tax, and that is a filing in addition to the exempt return, which requires the payment of corporate level tax at these rates. So the rates apply as well as everything else. And interestingly, smaller exempt organizations historically have not had income, you know, in a lot of their unrelated business activities that exceeds 50,000. So they were paying 15% at the marginal rates under old law. Now this is a flat 21% rate under the corporate law, and so their tax rate's actually going up 6 points. So you have to keep that in mind as you go through this as well. So we didn't have I mean, we could have made this an 8-hour session just on the tax laws. You can see it's fairly complex and it's fairly substantial. Again, probably the most prolific piece of legislation that I've seen since the '86 Tax Reform Act. One of the things that we've noted in our business valuation group is the impact that this has on valuation of enterprises. People buy cash flows. So if your cash flow used to be $1,000 pre-tax, $400 of tax, so you had net cash flow of $600, now you have more cash flow. And if you have more cash flow, theoretically, the business risks are the same, you should have higher values. And as I said, at the end of the day, we're starting with tax, we're going to end the day with tax, and Melissa Bijak, who's my partner in the valuation group, and Brad Matthews are going to go through some of the implications that we've observed in the valuation work that we've gone through since the passage of this law. It has a huge impact on valuation, and substantial considerations have to be taken into consideration there, apart from the actual compliance work that's out there as well. So I don't know if anybody has any questions. Dawn and I will be around on break. We have about a minute left. I would like, again, to thank you guys for coming today. I would also like to ask you to be respectful of our guest speaker today. We have Ms. Heather Like, who's the Director of Athletics at the University of Pittsburgh, who's, my own personal opinion, she's doing a marvelous job. She's going to come and speak after break, and so we'll have a timer running on the screen, and I'd ask if you could please try to be back in your seats so we can get her the time that we asked her to speak and make sure she gets her fair shot. So I don't know if there's anything else that needs to be covered, but I appreciate your time. I think we're there.
I think we're there.
Okay, thank you all. Enjoy your break.